Hello, welcome to The Deal, our quarterly outlook for European M&A markets. My name is Fenton Burgin and I'm the head of Deloitte UK's advisory corporate finance business. M&A activity is particularly strong, with deals worth over $960 billion so far this year, a 72% increase compared with a year ago, and the strongest period since 2007. Why is this happening? As the economy grows at a steady but slow rate, companies are looking to grow through acquiring revenue, people and new technology. Shareholder pressure and cheap financing are persuading companies to hunt for growth, sell non-core assets and deal with digital disruption. These factors, as well as strong equity markets, continue to support M&A activity. Deal valuations on both sides of the Atlantic remain at 30-year highs. We don't see that situation changing anytime soon. Of course, equity markets are now 40% higher than they were in 2007, so just looking at deal valuations doesn't give you the full picture. Nevertheless, we predict continued strong activity, particularly in the mid-market, which has largely shrugged off the threat of increased regulatory and antitrust intervention, that alongside concerns around China-US trade tariffs has slowed down deal flow in the billion-dollar end of the M&A market. What's the impact been to date? Yes, some people are concerned, and regulators will continue to scrutinise M&A in heavily consolidated markets such as energy and banking. But we're not seeing a range of chief executives pulling out of deals citing concerns around trade tariffs or antitrust. Private equity has more cash than ever to invest and is increasingly competing with trade buyers who've historically been able to pay more for assets. The valuation gap between strategic acquirers and private equity has actually fallen to zero in 2018. And in some sectors, such as financial services and energy, we've even seen private equity outbidding trade. What about Brexit? A range of commentators predicted the M&A markets locking up. We see the opposite as overseas buyers look to capitalise on recent short-term equity market volatility. The UK has seen some big deals this year, with bidders agreeing to spend over $220 billion on British targets, almost 40% up on last year. The biggest was Comcast's offer of more than $30 billion for Sky, and separately Takeda Pharmaceuticals' £45 billion agreement to buy London-listed drug maker Shire suggests likely increase in Japanese activity in UK M&A. Is this good news for consumers? We certainly think so, as the majority of mergers are pro-competition and good for consumers, leading to long-term lower prices. In summary, we see market momentum remaining strong as companies continue to turn to M&A to acquire technology, to drive growth, and to secure the scale needed to differentiate and compete successfully in global markets. Thank you for your time, and I look forward to speaking to you in the next quarter.